Hello everybody, in this video I'm going to talk about the tax buckets. There's basically three different types of buckets that you can place money into, and depending upon the vehicle that you use will determine how that money is taxed. So the first bucket is the taxable bucket. So what types of vehicles are in this bucket? Well, brokerage accounts, checking accounts, CDs or certificates of deposits, those types of accounts. There's probably more than what's listed here. But understand when you use this type of tax bucket, the money is taxed before it goes into the account, and then you're also taxed on any of the gains of the account. So that's the first bucket. The second bucket is tax deferred. What types of vehicles are in that? Oftentimes the vehicles that you hear about in there are your employer sponsored 401k, your solo 401k, 403b plan, and IRA. Those are vehicles in which the money is not taxed before it goes into the bucket, but when you start to pull money out of the bucket in later years, that money is then taxed. And then the final bucket is the tax-free bucket. The types of investment vehicles that are in that bucket are your Roth IRA, your Roth 401k, muni bonds, and life insurance. So the money is taxed before it goes into this bucket, but any gains that happen inside that bucket is not taxed when you withdraw that money. So the question is, which one's better? Well, it depends upon what you're looking to accomplish in your financial strategy. But from just a basic mathematical standpoint, let me show you some results. So I took just a hypothetical example here. We're going to take a $100,000 investment. You're going to assume that that investment grows at 6%. You're going to assume that in this scenario, they're in the 24% tax bracket, and then we're going to project that out for 20 years. So if you look at the taxable bucket, we start with the $100,000. Well, remember the money is taxed before it goes into the bucket. And so since it's a 24% tax bracket, only $76,000 is actually going to go into that bucket. Okay. So we take that taxable account, we deposit the $76,000, we compound it at 6% interest, and we pay taxes on the gains each year as that money grows. At the end of that 20-year period, the net balance is $185,407, and you've paid $58,549 in taxes. Okay, so that would be the balance there. That's the net balance after taxes are paid. When you look at the tax deferred bucket, same scenario. $100,000, but remember, we don't pay taxes when it goes into the bucket. So we're going to deposit the entire $100,000 into that bucket. And then that's going to grow at 6% for 20 years. So when you look at that, the net result is $229,945. Now, at the end of that 20 years, when we start to pull that money out, you're going to have to pay taxes on that money. Assuming you're still at the 24% tax bracket, that tax bill is going to be $90,769. So the $229,945 is net of the taxes that you've paid, but you can see that your tax bill is quite higher than just in the taxable bucket. Now, when you look at the tax-free bucket, same scenario, $100,000, but because it's going to grow tax-free, you're paying taxes on the money before it goes in there. So you're only depositing $76,000 into that account. And when you fast forward 20 years at 6% interest, the net result is $249,742, so higher than the tax deferred, and your total tax bill was $24,000 because you paid the taxes before the money went into the account, and then it grows tax-free, and you're able to access that money tax-free. So when you're looking at your investment strategy, make sure you understand how you're being taxed on the investment vehicles that you're putting your money into. And we'll talk to you next time. Thanks.